If there is one thing in economics that is beyond doubt, it is the main interest of investors in maximizing return on investment, ROI. This is already clear from the connection between the words investor, investment, and return. And since it is the main inherent economic interest of human beings, it should be regarded as a basic law of economics given by nature and should be respected as such. The substance of the economy as a living, constantly pulsating and evolving system is created by processes that generate products via resources. The characteristics of these processes determine the characteristics of the real economy as a whole. This is also true of ROI. Managing the economy by ROI, in order to maximize it, therefore means that its very substance, the processes that generate products via resources, are managed by ROI. If this is not the case, then the investor's aim of maximizing return of its investment in the real economy is just wishful thinking. The basic law of economics is ignored. And that is the reality. As explained in the prologue, quantifying the ROI of processes by product requires the use of a definite integral, a tool of higher mathematics that is not taken into account even in the classification of economic variables. The gateway to the realm of true economic science is thus closed. The basic law of economics and the interest of the investor are ignored. It is impossible to manage the economy at its most fundamental level according to ROI. And this crucial flaw in conventional economic science and practice cannot be corrected in any other area of economics. The definite integral is therefore, without exaggeration, the irreplaceable mathematical key to the entry of economics, at its most fundamental level, into the realm of true science, and its correct application constitutes a scientific revolution. Without the application of a definite integral, economic science and practice will never emerge from the realm of delusion at its foundations, because key economic phenomena are not measurable. Products, their processes and resources are managed in larger industrial companies by managers with different specializations and at different levels of the management hierarchy. Their common mission is to serve the interest of investors, who are their de facto employers, and therefore to manage products, their processes and resources according to ROI. This role of managers is also justified by the unique content of ROI. ROI is a comprehensive variable that inherently responds to all relevant physical parameters of products, processes, and resources, as well as the prices of products and resources in their interrelationships. Knowing this is fascinating and inspires admiration for the rationality of the laws of nature, even in their economic aspects. Is it at all possible that nature has combined the intrinsic content of a crucial economic phenomenon with the main human interest in it? However, it is not enough to be aware of the unique characteristics of ROI. It is necessary to describe them systematically using mathematics. In this respect, economics is not only no different from physics, but these sciences are closely related. In addition to the definite integral, PPROI software uses other mathematical methods not used in management theory to describe physical and financial phenomena and their relationships that result in ROI. This is in line with one of the main trends in contemporary science, which experts have identified as the application of previously unused mathematical methods that seemed useless in a particular field of science. This does not mean that the PPROI user should enter values of a definite integral or other values based on previous calculations outside the system. On the contrary, PPROI inputs are elementary parameters of products, processes, and resources. Among other things, this eliminates the need for external calculations of hourly costs of individual types of work centers and components of enterprise overhead, which are necessary for the calculation of direct and overhead costs of individual products by ERP. As noted in the prologue, PPROI does not use the misleading concept of overheads. All product cost components are generated by the parameters of specific resources. The same applies to the components of capital employed in processes by product. PPROI thus enables managers to fulfill their core mission of managing the enterprise's products, processes, and resources, and ultimately the enterprise as a whole according to ROI at its root causes. The PPROI SW can be thought of as a compass whose needle, when comparing different situations, tells you which one has the highest ROI and which one to prioritize when deciding between them. However, it calculates the ROI values for all situations considered. The future situation of the enterprise regarding ROI values is characterized by a summarizing and analytical reports. The summary report on ROI over the planning horizon, intended primarily for the company's executives, board of directors, and supervisory board, provides information on ROI and capital employed in individual processes by product and condensed statistical characteristics of ROI values. In the following example, we work with 10 processes by product in the enterprise. A visual indication of the ROI values in processes by product is provided by a chart in which the ROI values are sorted in ascending order, and the ratio of profit to capital employed is multiplied by 100, which is the usual way of expressing ROI in other contexts. Processes by product usually mean processes for different products, but they can also be process variants for a specific product if they exist in a particular enterprise. In the graph, the lowest ROI value is 4.29 and the highest is 12. 3 values are negative. They are loss-making processes. From extreme ROI values and all the columns in the graph, it is clear that the variance of the ROI is high. For the company as a whole, PPROI calculates and presents in the report 2 types of averages of the ROI values defined for the processes by product. In the weighted arithmetic average, the weight of each ROI value defined for the particular process by product is the capital employed in that process. This average expresses the true enterprise value of the ROI being generated. The company's planned ROI of 0.72 percentage points, or less than 1%, is too low, unacceptable to investors, and alarming to management. The report's key information about the company's ROI over the planning period is followed by a simple average of the ROI values calculated for the processes by product. The value of the simple average, 3.87, is higher than the weighted average of 0.72, which means that the weights of the ROI subvalues, i.e., the structure of the capital employed in terms of processes by products, have a negative effect on the company's ROI. The impact of the capital employed structure on the company's ROI is presented separately in the report as the third statistical characteristic of the ROI values. This is the difference between the weighted average and the simple average, and if this difference is negative, it is displayed in red. In our example, it is 3.15. To confirm the impact of the capital employed structure, the report includes a table that links the ROI subvalues to the capital employed data in respective processes, both in absolute values and as a percentage of the total capital employed. In our example, the negative effect of the capital employed structure is clear, because 51.73% of the total capital employed is in processes with 3 negative ROI values. In contrast, only 7.73% of the total capital employed is in the 3 processes with the highest ROI values. The variability of ROI values is summarized by the average deviation from the simple mean. Its value of 4.58 is very high, considering that the deviation from the mean goes in both directions, above and below the mean, so that the ROI values differ from each other by an average of 9.16 percentage points. The information in the PPROI summary report, which is critical to any industrial enterprise, is new both in terms of content and mathematics, and in terms of the presentation of the company dataset using descriptive statistics. As such, it should be a wake-up call not only to business managers, but also to investors, and not only to professionals, but also to academics, simply to everyone. There is no information about capital employed and ROI in the processes by product, not only in ERP, but also in any other set of information except PPROISW. The capital employed in processes by products and their ROI are not even considered in economic theory. Before the PPROI, everyone in the world was blindfolded in critical economic contexts, and outside the PPROI, this situation continues today. In such a theoretical, informational, and overall thought vacuum, managing the economy to maximize ROI is mission impossible. The basic law of economics and investor interest is ignored, and the economy as a whole suffers. Managers work unconsciously and unintentionally but constantly and systematically against the interests of investors, who are actually their employers, but who tolerate it because they, like the managers, are unaware of it. The dire situation of traditional management of the economy at its most basic level is succinctly expressed in red print on the left, in the comments to each variable in the ROI formula. Information on capital employed and ROI is missing, information on costs is distorted, and the standard formula used to calculate product prices is wrong, misleading. Nothing is okay. The alarming specific data that PPROI uncovered in the above report indicate the financial crisis of the company, which is largely result due to its mismanagement under the existing financial information prior to PPROI. Such numbers, or worse, are currently the case for a growing number of European industrial companies. And even when the company's ROI is more favorable, it is always much lower than it would be if companies were managing by ROI using PPROI information. The PPROI software changes the generally dismal information situation in all aspects. It introduces completely new critical financial variables, capital employed and ROI, and conceptually new product costing and pricing. The basic problem was illustrated by the example in the prologue. When comparing two processes by product, A and B, A is better in terms of profitability, 0.1 versus 0.056, but B is better in terms of ROI, 0.2 versus 0.1. This case is consistent with the general observation of optimization theory and practice. Like the criterion, like the evaluation, like the decision, like the result. When choosing between these processes, managers will prefer the more profitable process A because they have no information about the ROI of these processes and do not consider ROI as a criterion for evaluating processes by products. Process B with double the ROI is thus implicitly rejected, creating a conflict between the manager's actions and the investor's interests, in which the investors lose. Although this conflict is unintentional and no one is aware of it, this does not detract from its seriousness and systematic nature in various contexts. Managers are, in fact, the biggest permanent enemies of investors. The de facto superiority of profitability over ROI means that in the real world without PPROI information, managers who manage by profitability and ignore ROI are actually superior to investors. The relationship between investors as employers and managers as their employees is invalid, turned upside down in people's practical behavior. Managers have the upper hand over investors. They are first. Investors with their main interest are completely suppressed. PPROI software with capital employed and ROI information makes it possible to manage processes by product according to ROI. And in our example, managers should prioritize process B with higher ROI. By using PPROISW, managers connect their actions to the interests of investors. The traditional manager versus investor conflict disappears. The above example assumes that when calculating the profitability and ROI of processes by product, the price of the product is given, namely 110. In practice, however, the prices of products are not given in advance, but are first calculated in each company according to product costs. A clear problem with these calculations is the different distortions in product costs according to different costing formulas, which differ mainly in the overhead surcharges on what are considered direct costs. And different distortions in the cost of a given product results in its different prices. Therefore, when negotiating prices for various materials and components between companies in the supply chain, some companies require suppliers to substantiate their costs according to a formula prescribed by the customer. But even these formulas, which often originate in the financial controlling departments of large corporations, are different, mutually exclusive. Suppliers to different customers are then drowning in and confused by different costing formulas, all the more so because they use their own costing formula that they trust. But even if the product costing is correct, any product pricing that ignores capital employed and ROI in the processes for the relevant products is nonsensical and generate contradictory prices. In the standard pricing formula, the cost of the product is increased by a percentage markup that reflects the target profitability. The percentage markup on the cost of each product within a given company is usually uniform, so that different products are not advantaged or disadvantaged relative to each other in terms of profitability. The level of profitability is set as a target by management. However, setting the same profitability for all products also means setting different ROI values for each product. This explains the large variability in ROI values in the report above. If the target profitability in our example is 0.1, then the product price in process A for this product is 110, and in process B it is 114.4. At this price, the profit in process A is 10, in process B it is 14.4, and the difference in ROI values is diametric. In process A, the ROI is 0.1, in process B it is 0.48, i.e., almost 5 times higher. Thus, the standard pricing formula assigns a higher profit and a much higher ROI to the individual processes by product. The lower the capital employed, i.e., the investment in the process. So with standard pricing, the more you invest in a process for a given product, the lower your absolute return, your profit from that process, and its ROI plummets. This is true in any context. Isn't that absurd? However, if prices are unilaterally linked to costs, and there is no information on capital employed in processes by product, there is no way out of this absurdistan. For maximum specificity and clarity for everyone, we will use the example of central regulation of electricity prices for nuclear and gas-fired power plants in EU countries in 2022 to 23 due to a sharp increase in gas prices. The following data are given in years and kilowatt years for 1 kilowatt. Although the specific values are fictitious, and the actual values in individual EU countries differed from them in various ways, this does not change the nature of the problem. In the baseline before the gas price increase, a nuclear plant had a capital employed of 0.3 and a cost of 0.1. In contrast, a gas-fired plant had a capital employed of 0.1, 3 times lower, but costs were significantly higher by 0.04 at 0.14. The price was the same, 0.155. Profitability and ROI were higher for the nuclear plant. Profit 0.05 versus 0.15. Profitability 0.55 versus 0.107. ROI 0.183 versus 0.5. Due to a sharp increase in the price of gas, the costs at the gas-fired plant increased from 0.14 to 0.18. This resulted in negative values for profit, 0.25, profitability, 0.138, and ROI, 0.25. For simplicity, we assume that the situation for the nuclear plant remained unchanged. Due to the unsustainable financial situation of gas-fired power plants, the central authorities resorted to price regulation, setting prices for all types of power plants according to a standard pricing formula. All types of power plants were given prices that ensured the same profitability, and companies were heavily penalized for exceeding these prices. Let us assume that this profitability is 0.1 love. Then the price in a nuclear power plant is 0.112, and in a gas power plant is 0.202, i.e., the price in the gas power plant was 80% higher than in nuclear one. Absurd, but consistent with the general flaws in the standard pricing formula described above are profits and ROI. The profit in a gas plant, ILX 0.022, is 83% higher than in a nuclear plant, where it is 0.012. However, the capital employed, i.e., the investment for 1 kWh, is 3 times higher in a nuclear power plant, 0.3 versus 0.1. This confirms the paradoxical property of the standard pricing formula defined above. The more you invest, the less you earn. The higher profit and lower capital employed in the gas plant result in a ROI of 0.22, which is 5.5 times higher than the ROI in the nuclear plant, where it is only 0.04. Thanks to the higher costs in the gas plant, everything is upside down. The impact of price regulation on ROI is diametrically opposed for each type of power plant. For nuclear power plant, the ROI dropped sharply from the baseline of 0.83 to 0.04, so investors there are being hit hard by price regulation, while the ROI of a gas plant rises from the baseline of 0.15 to 0.22. Isn't that absurd? Such a blatant situation was created by governmental managers backed by politicians. But no one objected. Corporate executives, bankers, investors, academics, etc. were silent because they all consider the same prescribed profitability to be fair and do not think through the implications for ROI. This just goes to show the need, mentioned in the prologue, to teach the basics of financial literacy in elementary school, so that when people grow up, they don't expect the profit to match the costs. The conflict between managers' thinking and actions in terms of the costs and profitability of products and investors' interest in ROI is reflected in the isolation and conflict between management and financial accounting, the two basic sets of financial information. In the respected book, Introduction to Management Accounting by Professors Charles T. Horngren and Gary L. Sundam, which has been published in many editions over the past few decades, the main differences between management accounting and financial accounting are seen in the following aspects: object of information, external restrictions, time horizon, and main users. The objects of management accounting are products and other intra-enterprise entities, while the object of financial accounting is the enterprise as a whole. Management accounting information is not restricted by anything, whereas financial accounting is strictly restricted by Generally Accepted Accounting Principles, GAAP. Management accounting is primarily future-oriented and used for planned management, while financial accounting reports on the results of past periods. The main users of management accounting are managers at various levels, while financial accounting information is intended for investors and government authorities. However, this comparison overlooks the most important aspect: the difference in variables. The basic variables of management accounting are cost and price, from which product profit and profitability are derived. These variables are also included in financial accounting, with product prices being reflected in enterprises' sales. In addition, however, financial accounting includes assets on the balance sheet that allow the calculation of the enterprise's ROI, which is the top comprehensive ratio variable in financial analyses of past results. This difference in variables has negative consequences for management from all aspects. The management of intra-enterprise entities adversely affects the key characteristics of the enterprise as a whole. The enterprise is not described and managed as a system. The planned management of the enterprise's future attributes is inconsistent with the subsequent evaluation of the enterprise's past performance. Evaluating the enterprise's past performance does not allow to assess the impact of ROI of processes by product, which is essential. Financial accounting does not contain this information, and without it, any reporting and analysis is of little use. If management accounting does not provide managers with the data that investors are interested in, then the fundamental question is in whose interest the companies are being managed. And because management accounting is not restricted by anything, it is possible to supplement traditional management accounting variables with capital employed and ROI, and replace existing biased methods of product costing by correct one. Overall, it is necessary to provide managers with comprehensive information support for the systematic management of intra-enterprise entities and the enterprise as a whole by ROI. This is the purpose of PPROI. The PPROI does not, of course, have any effect on the financial accounting, but for management purposes, it allows the prices of buildings, machinery, and other equipment recorded here to be replaced by actual prices. Returning to the new PPROI variables, capital employed and ROI of processes by product, the example of two different types of power plants illustrates a common case, where the costs and capital employed are inversely related in the situations being compared. Where the cost of a particular product is lower, the capital employed in the process for that product is higher. There are several reasons for this. In the case of electricity generation in different types of power plants, the physical resources and processes involved are generally different. Much more common reasons are the different scope of processes for a product within an enterprise and the different degree of automation and robotization of processes. Both of these are discussed in the case study in the next part of the video. But even now, at a general level, we are commenting on the contradictory evaluation and management of manufacturing processes in terms of profitability and ROI in relation to investment in new machines replacing manual work and/or simpler machines, which is a long-term trend. The main reason for these investments is to reduce the costs of the processes involved. Otherwise, the investments would not make financial sense. Before an investment is made, the internal rate of return, IRR, a version of ROI calculated from the cash flow over the life of the machine, is commonly used to make decisions. However, in standard product pricing, the calculated IRR is an impossible fiction. This is also true for the net present value, NPV, and payback calculations that are performed along with the IRR in corporate investment departments. If, after the investment in new machines, the processing costs of the operations at the work centers where the new machines operate decrease, the costs of all products processed at that work centers will decrease. In standard product pricing with a percentage markup on costs, the prices of the relevant products decrease as costs decrease. And because the absolute decrease in prices is greater than the decrease in costs, the profits from the products concerned also decrease. The example illustrates the behavior of the variables for a given product. The cost of the product decreases from 100 to 96 after the investment in machinery. With a 10% markup on the costs, the price of the product decreases from 110 to 105.6. Such a reduction in the price of the product is seen as a major benefit of the investment, making the product more competitive, welcomed by customers. Customer first. However, because the decrease in price, 4.4, is greater than the decrease in costs, 4, the profit on the product decreases by 0.4, from 10 to 9.6. After the investment in the machines, for a given quantity of individual products, the capital employed in the processes for the products in which the machines operate increases. As a result of the increase in capital employed and the decrease in profit, the ROI of the processes for the respective products decreases. In our example, suppose that the capital employed in the process for the product in question increases from 100 to 120, the opposite change to the costs, which decrease from 100 to 96. Because the profit decreases from 10 to 9.6, and the capital employed increases from 100 to 120, the ROI decreases from 0.1 to 0.8, i.e., by 20%. Managers feel good about how the lower price of the product under review and other products made on the new machines has increased their competitiveness. Customers welcome it, but investors are beaten. This has a negative impact on the company's ROI, which is calculated over the past period, but no one sees this relationship. Like the electricity price example above, this example is sufficient to reject standard price calculations altogether. Mathematical formulas that fail specific logical test should always be rejected in general. In traditional economic theory and practice, however, this misleading pricing formula has no meaningful alternative, since information about capital employed and ROI in processes by product does not exist. Since this information is available in PPROI, a pricing formula that respects the superiority of ROI over profitability can be applied by rearranging the ROI formula. In PPROI pricing, the calculated price of the product, taking into account both the costs and the capital employed, is the sum of the costs and the product of the capital employed and the target ROI. The product costs are therefore increased by the profit corresponding to the capital employed in the process for the product and the target ROI value. Targeting ROI is a fundamental premise for managing a company's products, processes, and resources, and thus the company as a whole, in line with investor interests, and should be the case for product pricing. To illustrate the difference between traditional and PPROI pricing, assume that the cost and capital employed before and after the investment are the same as for standard pricing, and that the target ROI is 0.1 instead of the target profitability of 0.1. Then the price of the product after the investment decreases from 110 to 108, and the profit increases from 10 to 12, i.e., by 20%, in proportion to the increase in capital employed. The calculated price in PPROI pricing is the limit up to which the price can be reduced without decreasing the ROI and harming the investor. If the baseline price is maintained at 110 after the investment, then as the profit increases from 10 to 14 and the capital employed increases from 100 to 120, the ROI increases from 0.1 to 0.177, significantly exceeding the target. Investor benefits, customer is not harmed. Both the investor and the customer benefit at any price between the base price and the post-investment PPROI price. For example, at a price of 109, the base price of 110 decreases by 1, and the ROI increases from 0.1 to 0.108. Not every investment is beneficial. For a given cost reduction, capital employed growth is critical. In the example on the left, whereas costs decrease from 100 to 98, and capital employed increases from 100 to 140, the PPROI price increases from 110 to 112. The product becomes less competitive without any benefit to the investor in terms of ROI. Product price and ROI thus form a pair for assessing the competitiveness of products and the processes that produce them. Competitiveness is no longer a vague, immeasurable concept. Achieving and maintaining competitiveness requires, first and foremost, setting challenging targets for both variables. While the target ROI may be the same for all products and relatively stable over time, the target prices are different for different products and should decrease gradually, taking into account inflation. Achieving challenging targets is only possible by reducing costs and/or capital employed in processes by products. These variables therefore form the other inseparable pair in managing companies for competitiveness. The opposite changes in costs and capital employed that we have addressed are not always necessary. Positive changes, i.e., decreases, can occur simultaneously in the values of both variables. A key factor in reducing both the costs and capital employed of individual products is to increase the quantity of products, given fixed resources. Since processes for different products share some or all of the same resources, the cost and capital employed for a particular product depends on the quantity of all products, and the PPROI reflects this. Just as in a real enterprise, which has the characteristics of an organism, a living, changing system whose interrelated elements form a whole, so it is with PPROI software. Nothing is isolated, not only with changes in the quantity of a product, but also with other partial changes in PPROI's input data. The costs, capital employed, and ROI of all products change. Also, this feature is revolutionary and distinguishing PPROI from ERP. Product costing in the ERP does not even react to changes in the price of electricity, because this recorded price, like the prices of many other consumed resources, has no mathematical link to product costs. The target ROI value should be challenging, because the lower it is, the easier it is to achieve a given product price. The easier it is to satisfy the customer at the expense of the investor, the less pressure there is to reduce costs and/or capital employed in processes by product. Setting ROI target IOL 0.15 seems unrealistic with the values in the report above. However, these values found in the initial PPROI calculations from the actual values of the variables are largely the result of ignoring capital employed and ROI and underestimating costs in traditional product pricing, and the first step should be a complete repricing of products. When it comes to the targets and their fulfillment, it is useful to remember the leadership of John Welch, president of GE in its heyday, as well described in Janet Lowe's slim book Jack Welch Speaks, subtitled Wisdom from the World's Greatest Business Leader. Welch's concept of the stretch, setting challenging, seemingly unattainable financial targets and finding ways to achieve them, seems relevant and timeless. Coming close but not reaching these targets is not a miss or a broken commitment or a black eye, but a triumph to be celebrated. It's much better than meeting easy goals. Also, GE's then concept of teamwork, called workout, bringing together people of different ranks and functions, and sometimes customers and suppliers, to solve specific problems, is still relevant today. PPROI brings a whole new level of information support to this type of teamwork by projecting quantified proposals for partial changes into the ROI. In this context, it is clear that PPROI can serve everyone.